Welcome to the deep dive. Today we're digging into the latest numbers from OneSource Specialty Pharma Ltd. We're looking at their Q1 results for fiscal year 26, so that's the quarter ending June 30th, 2025. And like always, our goal here is to, cut through all the jargon and the dense reports. We want to pull out the really essential insights, maybe some surprising details, and the key strategic moves that are shaping where this.
That's a really great place to start because it highlights a key point. The difference between reported and adjusted figures. You're right, the consolidated profit or loss after tax, straight from the official statements, was a loss. Specifically, 1.86 million Indian rupees INR for Q1 FY26.
A loss, okay.
But the adjusted paid profit after tax that they talk about in the press release, that shows a profit of 371 million INR.
Wow, that's a huge swing. So how do they get there?
It basically comes down to two main adjustments they've made to get to that adjusted number. First, there's what they call an exceptional item. It's a loss 28.7 million INR. This is tied to some legal charges from an old litigation. We can get into the specifics of that later on.
Okay, legal charges. What's the second adjustment?
The second one is bigger, actually. It's 344 million INR for something called scheme-related intangible amortization. So the idea behind showing these adjusted figures is to give you a clearer view of the underlying operational performance. They're stripping out these specific costs that aren't part of the day-to-day core business or one-offs.
Right, so the adjusted numbers are meant to show how the actual business operations are doing, minus these, let's say, non-operational hits.
Exactly. It paints a picture of operational health.
Okay, that clears up the loss versus profit confusion. So focusing on that adjusted picture, what does that positive growth story from the press release really tell us about OneSource's momentum? Where are they heading year over year?
Well, looking at those adjusted numbers, they point to a really strong operational quarter. It seems like it was right in line with what management was expecting. If you compare this Q1 to the same quarter last year, Q1 FY25, the growth is pretty clear. Revenues hit 3,273 million INR. That's up 12% year over year.
12% revenue growth, solid.
Yeah, and what's maybe even more impressive is the EBITDA growth. That reached 885 million INR, which is a 37% jump compared to last year.
37% on EBITDA, that's significant.
It really is. And it means their EBITDA margin expanded quite a bit too, hitting 27%. That's up by about 500 basis points year over year, a big improvement in profitability.
Wow.
And all that flows down to that adjusted profit after tax we mentioned, 371 million INR, which is a major turnaround from the loss they had in Q1 last year. This translates to an adjusted earnings per share, or EPS, of 3.2 INR. So yeah, the adjusted figures definitely signal a healthy, growing, then more efficient core business this quarter.
Driving the momentum operational strengths in business development?
Okay, so the underlying business is clearly performing well, getting more efficient. But let's look beyond the financials for a moment. What's actually driving this? What operational factors or business development wins are fueling this momentum?
Well, the source materials point to a few key things. First, they've made it clear that the CDMO, that's Contract Development and Manufacturing Organization segment, is now their only reportable segment.
So real focus there.
Exactly. It suggests a very focused business model, concentrating their resources. And on the business development front, they had a good quarter. They secured 6 new contracts and received 25 RFPs, requests for proposal, across their different services. So that shows a healthy pipeline, future business potential.
Good signs for future revenue.
Definitely. They also mentioned doing major capacity expansion work at their main site. This is specifically to get ready for upcoming commercial launches in the drug-device combination, DDC space.
The DDC area seems pretty important for them.
It does. And tied to that, a really crucial point. They successfully cleared back-to-back inspections from both the US FDA and Anvisa Brazil for that flagship DDC facility.
That's huge in this industry, right? Passing those inspections.
Absolutely critical. It's not just about compliance. It validates their quality systems, and it's essential for commercializing products, especially in major markets like the US and Brazil. It gives them a real edge.
Makes sense. That regulatory success is a big deal. Can we zoom in a bit on those specific offerings? Like DDC, biologics, and the soft gels and sterile injectables? How are those areas doing individually?
Sure. For DDC, they mentioned seeing continuous upward revisions in the commercial forecasts from their partners, which suggests growing confidence. They're also ready for pre-commercial manufacturing for launches that are coming up soon. Plus, they've signed new master service agreements, MSAs, and expanded existing ones. That points to deepening relationships with clients.
Good, sticky business. What about biologics?
In biologics, there's a new partnership with a company called Xbrain. Apparently, this is helping speed up the regulatory approval for their drug substance facility. They also mentioned having a strong pipeline here, with over 10 active discussions, including some in novel areas, so positioning for growth there too.
And soft gels and injectables.
For soft gels and injectables, they highlighted a noticeable increase in RFPs, again showing demand. And they've signed new agreements specifically with existing customers. That's often a great sign, means current clients trust them enough to give them more work.
A bold leap. The potential strategic acquisition.
Okay, so strong core business, good momentum across the board. But then, alongside these results, they announced something potentially, well, transformative, a major potential acquisition. This sounds like a really interesting strategic move. What are the details here?
Yes, this is definitely a significant development. The board has actually set up a special subcommittee made up of independent directors.
Okay. To do what?
Their job is to evaluate a potential strategic acquisition. Specifically, buying 2 U.S. FDA-approved specialty injectable assets from a company called FY26 Specialties.
2 U.S. FDA-approved assets. That sounds substantial. What are they?
Right. The first one is a U.S. FDA-approved fill-finish manufacturing facility. It's located in Warsaw, Poland.
Poland. Interesting. Geographic expansion.
Exactly. And this facility has capabilities not just in specialty injectables, but also in biologics. And importantly, it has room to potentially expand for drug-device combination products, which, as we said, fits right into OneSource's strategy. Apparently, it already serves global clients with some advanced IP-led products, including something called a 505(b)(2) specialty injectable. That's a specific regulatory pathway in the U.S.
Right.
And it's worth noting, the source mentions this Polish business is majority owned by the promoters of OneSource in partnership with TPG.
Okay, interesting ownership structure there. And the second asset?
The second asset is different. It's described as an integrated state-of-the-art U.S. FDA-approved carbapenem facility. This one's in Vadodara, India.
Carbapenems, those are specific types of antibiotics, right?
Correct. Highly specialized. This facility operates as Brooks Stericyence Limited. And in this one, the promoters hold a minority stake.
So adding fill finish in Poland and carbapenems in India, why is this such a big deal for OneSource, strategically speaking? What does this potentially unlock for them?
Well, if this goes through, it offers some pretty clear strategic advantages. First, enhanced capabilities. They'd be adding specialized know-how in fill finish and carbapenem manufacturing, which are high-value areas.
Broadens their service offering.
Definitely. Second, geographic expansion. That facility in Poland gives them a manufacturing footprint right in Europe. Big deal for serving European clients and maybe accessing new markets.
Makes sense.
And third, portfolio diversification. It just broadens their overall offerings and likely their customer base too. Adds resilience.
So potentially quite transformative.
Potentially, yes. Of course, they were quick to point out that any deal is subject to all the usual regulatory hurdles and shareholder approvals, but the intent is clear. They're looking to scale up significantly in specialized areas.
The long game, financial health, and future outlook.
Okay, so we see strong current performance plus this bold potential acquisition. How does all this connect to their longer-term picture? What's the vision for, say, the next few years in terms of financial health?
They actually reaffirmed their ambitious organic growth targets out to FY28. And these really underline their confidence. They're targeting a revenue AGR compound annual growth rate of more than 30% between FY25 and FY28.
Over 30% CGR. That's very ambitious.
It is. And alongside that, they're aiming for EBITDA margins to reach around 40% in a steady state.
40% EBITDA margin. That would be top-tier performance.
Absolutely. They're also focused on capital efficiency, targeting a return on capital employed, ROC, above 50%.
Wow.
And managing debt, carefully aiming for net debt to EBITDA below 1.5x, the ultimate goal, to be net cash positive by FY28.
So high growth, high profitability, strong returns, and a healthy balance sheet. That's the plan.
That's a long-term vision they've laid out.
Achieving those kinds of targets, especially the growth and margin expansion, usually requires significant investment, right?
Right.
What are they saying about capital expenditure to support this?
Yes, they addressed that. They mentioned that over half of their planned CapEx, which is roughly $100 million for capacity expansion, has already been committed.
Okay, so the spending is underway. How are they funding it?
It's a mix. They said it's coming from internal cash flows, commitments from partners, and some debt. So it seems like a balanced approach. They also specifically mention accelerating phase 2 of their DDC expansion and upgrading an injectable site to add some niche capabilities. So the investment is targeted towards those high-growth specialized areas.
Makes sense. Aligns with the strategy.
And just to round out the company profile, they remind us they're a pure-play specialty pharma CDMO, 5 main manufacturing sites, all globally approved, over 1,300 employees, and they really emphasize their compliance track record, over 210 successful audits. That trust factor is just so important in this business.
The finer details and key nuances.
All right, let's dive into some of the finer print now. Often, the notes in the financial reports hold some really important context, maybe things that don't make the headlines. What nuances did you pick up from the details?
Yeah, there are a few interesting points tucked away. Let's go back to that exceptional loss we mentioned earlier, the 28.70 INR.
The legal charges, right?
Right. The report clarifies this stems from a legacy litigation. It involves a subsidiary, Biolexis Pete Limited, and another company, Prestige Biopharma Limited. Apparently, it relates to the termination of an old contract for manufacturing the Sputnik vaccine.
Ah, okay. Sputnik. Seems like a while ago.
It does. Prestige is claiming a very large amount, USD 136.32 million. But Biolexis has filed a counterclaim for USD 13.62 million. And OneSource's management stated they believe Prestige's claims are, and I quote, false, baseless, and misconceived. The whole thing is currently pending before the Singapore International Arbitration Center, or SIS.
So, a potentially large claim hanging out there, but they seem confident in their position. Good to know the context. Anything else?
Yes. They noted that the sale of their Unit 3 facility to Syngene International is now complete. And importantly, in Q1 FY26, there was 0 loss recorded from discontinued operations related to that sale, which is better than the previous quarter, tidying things up.
Good. Financial housekeeping.
And on the debt side, they mentioned they fully repaid their listed non-convertible debentures during the last fiscal year, FY25. That improves their financial flexibility, less debt burden.
Always a good sign. What about the auditors? Any notes from them?
So the auditors, Deloitte Haskins and Sells, issued what's called an unmodified conclusion. That's generally what you want to see. No major red flags raised about the current quarter's financials.
Okay.
However, they did make a couple of points. One, they noted that the comparative figures for Q1 of the previous year, Q1 FY25, were not audited or reviewed by them.
Standard practice sometimes, but noted.
And second, they pointed out that the consolidated results for this quarter include financial information from some subsidiaries that were reviewed by other auditors, or in some cases weren't reviewed or audited by any auditor, but were certified by management. Again, this isn't necessarily unusual for a large company with lots of entities around the world, but it does underscore the complexity of putting together these consolidated financials and maybe why focusing on those adjusted operational figures and the broader strategy is helpful.
Absolutely. Understanding those layers is key. One last area, did they mention anything about changes in leadership or the board that can often signal strategic shifts or strengthening governance?
They did.
Yep.
They highlighted a couple of significant appointments aimed at bolstering their team. They brought on Colin Michael Bond as a non-executive independent director. He was previously the CFO at Sandoz, so brings a lot of big pharma finance experience to the board.
Strong addition.
And they've appointed Jeffrey Wong as their new chief business officer. His background includes roles at major players like Syngene, Fujifilm Diosynth, and Thermo Fisher, so deep experience in the CDMO business development world.
Okay, so bringing in experienced hands at both the board level and in a key operational role seems like they're gearing up. Outro. All right, so pulling this all together, OneSource Specialty Pharma's Q1 presents a really dynamic picture, doesn't it? On one hand, you have that reported loss initially causing maybe some confusion, but then the adjusted figures show strong operational growth and improving margins.
Right, a clear improvement in the core business.
And then you have these ambitious long-term targets pointing towards significant growth and profitability ahead. And layered on top of all that is this potentially game-changing strategic move, the plan to acquire those 2 U.S. FDA-approved specialty injectable assets. It signals real ambition.
It certainly does, which leads to an interesting thought to leave you, the listener, with. Given OneSource's, let's say, multi-layered financial reporting, their very ambitious FY28 goals, and now this significant potential acquisition, how might adding these specific assets, the Polish fill-finish facility and the Indian carbapenem plant, how might they truly transform OneSource's position in the global CDMO market? And maybe more importantly, what unique challenges integration, cultural, operational, might they face in actually weaving these new pieces into their existing structure to hit those aggressive targets? What really stands out to you from everything we've unpacked today?